Hello, my name is Faisal Khan. I'm a banking and a payment consultant, and today we will talk about what central banks look for in inward remittances. So the most important thing is they're looking at foreign exchange coming in. As a central bank of a country, the biggest thing what remittances do is they increase the foreign exchange reserve. So when money comes in, the central banks take the money and you surrender the foreign exchange and you get the local currency instead. The central bank can print as much currency as they want, but local currency only. So they take the foreign exchange from you and they give you the equivalent in nairas or rupees or takas or what have you. What happens on the country level is the dollar reserves or the pound reserves or the euro reserves of the country goes up. So at any time a remittance is done, the central bank is looking at ways of increasing their reserves. So foreign exchange needs to flow in. That is very, very important. What makes it different from Bitcoin remittances is, let's take an example of Chicago to Manila. So if someone's sending traditional remittances, that money will eventually, the $1,000 from Chicago, that money, $1,000 minus the fees, will eventually come into Manila. And the $1,000 will be surrendered to the central bank, and the equivalent in Filipino pesos would be given. But when you do the same transaction using Bitcoin, you take $1,000, you buy Bitcoin, those Bitcoins are transported to, let's say, Philippines, they're sold on the local exchange, and the local exchange will give you the local Filipino pesos equivalent, and that money is now sent into the beneficiary. The foreign exchange reserves of the country have not improved unless you take those Bitcoins, sell it in London or in Amsterdam, and then bring that money back into Philippines. The foreign exchange reserves of the country have not improved. All you've done is you've taken payment from the US in form of Bitcoins, bought it in, sold it locally at a local exchange, cashed out in a local currency which is already there in the economy, and just set it aside for the beneficiary. So when you look at Bitcoin remittances, if those Bitcoins are being sold at a local exchange, the foreign exchange reserves of a country do not improve. And hence the country deems it that they're being robbed of the very much needed foreign exchange. What they can do to make it legal is to say, okay, you've sold your Bitcoins, why rather than selling them locally, why don't you sell them internationally and bring those dollars in? One of the reasons why they don't do that is obviously because of arbitrage. The Bitcoin price may be lower in Canada, maybe slightly higher in India, so they want that little bit of extra cushion that they can get. But this is one of the main reasons why most of the central banks worldwide do not encourage Bitcoin remittances. It's a mindset, it'll eventually change, but they feel that they're getting robbed of the much needed foreign exchange. So if you're making or designing a remittance product, always keep this factor in mind, that the central bank is looking at increasing foreign exchange reserves, that in your flow of funds and in your transaction set, that the foreign exchange does indeed come into the country. I hope I was able to answer the question. Till next time, take care.